FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
And it's Monday, May 5th, Cinco de Mayo, and we are back on the Financial Survival Network, and this episode is brought to you by Owings Metals. They've got a great special for May, free shipping, and don't forget, if you enter the contest this month, we'll have a live drawing right after the 1st of June. You may win a half-ounce Gold Eagle. That's right, a half-ounce Gold Eagle. So check them out at owingsmetals.com. Make sure you tell them Kerry sent you. Got amazing wearable wealth. Owings Metal, also now known as Borderless Holdings. So up next is John Rubino, dollarcollapse.com, and we're talking about the first quarter GDP results. They're pitiful, the latest employment numbers, and what's going on in Crimea and Ukraine, and a whole lot more. Got John Rubino of dollarcollapse.com on, and his latest piece, Even Worse Than It Looks. We're talking about these sterling GDP numbers where GDP came in just 0.1% ahead, and you have to wonder what it would really be if they were accurately regurgitating inflation numbers, right, John? I mean, it's crazy.
Hey, Kerry. Yeah, the first quarter GDP report painted a picture of a really slow-growing economy, one that looks like it's getting ready to tip over into recession. And then when you dig into the report, it gets even worse, because it turns out, to the extent that there was any growth at all, it came from healthcare spending. Because of the new healthcare plan that's being implemented. More and more money is being spent on health insurance and going to the doctor and everything, which, in individual cases is a good thing, but in a societal sense, that's sort of the broken windows theory, where you're not increasing your productivity or anything. You're spending it on something that has to be fixed rather than something that's being created. So you're increasing the number that shows up as GDP, but you're not actually producing anything new with that. So to the extent that healthcare is driving the economy, that means we're not actually producing anything that anybody can use. And the other thing that's really notable about this GDP report is that they use a really, really low inflation number, which is how you adjust GDP for changes in price levels. And the higher the inflation number that you use, the lower GDP is. So when you use a really low number to deflate GDP, that means you're artificially increasing the amount of growth that you're reporting. And the government uses a number that's just lower than any other measure that's out there. So if they had used a realistic number, we would have been very negative. In other words, the economy would have shrunk in the first quarter of the year. So the reality is that we're dropping back into recession based on this report. And then right after that, they came out with a really favorable looking employment report. It looked like 280,000 new jobs had been added in the previous month. But when you dig into that, you find out that it was basically an assumption that they made. There's something called the birth-death model, where they
BD, right?
Yeah, where they make a bunch of assumptions and then impute an increase or decrease in the number of jobs from these assumptions. And they made some wildly optimistic assumptions this time. So the number that they got for added jobs that they didn't actually count in the real world, they just made it up in their model, is higher than we've seen for, maybe ever. It was a huge increase. So most of the employment gains that they reported were something that they kind of made up. And at the same time, more people left the workforce than were reported to be added to the rolls of workers. So the number of people working actually went down, or working or looking for work actually went down in the last month, which means that the number of people working are actually supporting more and more people who aren't working, which is a really negative trend. And so taken together, these numbers looked either neutral or pretty positive, but when you dig into the guts of the reports, it's actually very negative. The economy is not doing nearly as well as they're reporting. And why is that a surprise? They've been doing this for a long time, where they're one way or another falsifying the inflation data that they use, or the assumptions on which they base a lot of glowing increases in other measures. And so this is just one more example of that. And the people who are doing the real analysis of the economy are painting a very negative picture right now compared to what the government is saying.
Yeah, and you saw on Friday and then again today, gold prices spike. And, you go over to Zero Hedge, you look at their analysis, and they're great deconstructors of the economic statistics. And you look at people with full-time jobs, 118 million, 0.4 right now. And then you look at people not in the labor force, 92 million. The so-called unemployed, that's the official statistic under the U1, 9.8 million. And then you add in people with part-time jobs, 27.3 million. You come up with 129.1 million. And that's your total job market of 202 million people, that comes out to like 227 million people in the job market. And the fact is that the minority of people have full-time jobs. I mean, it's staggering when you look at it this way. And 1 in 5 households have not one single person with a job. I mean, that statistic came out a week or two ago. Don't you find that one staggering, breathtaking?
Well, all of this is pretty staggering. And one of the really interesting things about the employment reports that the government has been putting out is that they count part-time work the same as a full-time job. In other words, if you get 22 hours a week at McDonald's, that counts in their statistical analysis exactly the same as a $200,000 a year job at a law firm, and or a $70,000 a year job at a high-tech factory. And the fact is, the majority of new jobs that have been created in the last couple of years have been part-time service sector jobs. In other words, you're a waiter, or you're working part-time at a retail store or something like that. And these are jobs that at best are temporary because of technology. Retailing is automating at a really dramatic rate. There are all kinds of things within the retailing sector now that can be done by robots, or point of sale terminals where you just pay with your cell phone or whatever, and you don't really need a sales clerk to walk you through the process. And same thing in food service. It's being automated. So these jobs are, crappy jobs that don't pay very well to begin with, and they're on the way out anyhow. So we're creating a structure that is incredibly vulnerable and not very good in the present. So it doesn't look like there are any trends that are positive in any of these things that we're talking about. We've hollowed out the economy by shipping most of our manufacturing overseas, and we've become a service economy. And now the service sector is threatened by technology. So I don't know what the solution is in the short run, because all we've got as a macro tool is monetary policy. You lower interest rates dramatically. Maybe you increase government spending and you run a big deficit, and you have the government temporarily employ people, but none of that actually fixes the underlying problem, which is a shortage of good jobs, making real stuff that pay a decent wage. And what the solution for this is in the short term, I don't know, because it doesn't look like any of the policy options left to the government are really effective. It doesn't look like we can put people back to work doing things that they're going to be able to do for the next 20 years and support a family.
Yeah. And, then the other trend of these middle-aged people moving back in with their elderly parents, I mean, that's a great trend that doesn't bode well. 100 some odd thousand of them in California, and I assume it's happening probably in Florida and all over the country. And where's the hope here? Where's the hope and change?
Yeah. Well, that trend kind of ties into the whole part-time work thing, because if you're a middle-aged person and all you can get is a part-time job that is a little bit above the minimum wage or at the minimum wage, you can't live alone, and you certainly can't support a family that way. So you're seeing 35, 40-year-olds moving back in with their parents and bringing their kids with them. So you got these big extended families in one house now, which we didn't used to have. And that's terrible for the housing market, which is a reason that housing seems to be kind of rolling over in the U.S. Home sales are down, and home building is way, way, way below the rates that prevailed during the peak of the housing bubble 5 or 6 years ago. And there also doesn't appear to be a solution for that. And housing is a big driver in the economy. When you build a house, the bankers make money, and the construction companies make money, and the furniture stores make money, and it's all because you borrowed a bunch of money to buy a house. So you take that away, and that's one big, formerly fast-growing sector of the economy that's now shrinking. And again, there's no real solution to it. And it all comes back to the fact that we borrowed a huge amount of money early on. Over the last 30 years, we've been borrowing more and more money each year, and we've kind of hit the point where we can't borrow much anymore. And so that means everything slows down, because you can't have aggressively rising consumer spending when consumers already owe a lot of money. You can't have the government continuing to run gigantic deficits when it's already doubled its debt in the last 5 years. So we're hitting a wall beyond which we can't continue to borrow at really aggressive rates, and yet we don't have anything else we can do. There's no way to keep things growing unless we keep borrowing more money. As Doug Nolan at Prudent Bear says, we're now at the point where it's inflate or die. Yeah. And so the only thing that's left is to decrease the value of the currency and hope that helps with foreign trade or whatever, and incents people to borrow even more money because they don't want to hold the currency that they've got. If the dollar's depreciating year after year after year, it makes sense to borrow money because you're paying your loans back in cheaper currency in the future. And that's a horrible kind of public policy where you depreciate your currency and convince people to borrow because they think the currency is going to get even weaker. But it's all we've got left. That's the final policy option in what is an increasingly terrible set of options. And it's what we're going to choose going forward. And historically, that's been a recipe for disaster. There's never been an episode where governments adopted this kind of policy in an aggressive way and it ended well. It's always ended with some kind of a disaster. So here we go again.
Great point. And more on that when we return on the Financial Survival Network.
FSN Radio.
Are you worried about protecting your wealth against a dollar collapse? Worried about gold confiscation? Owings Metals provides wearable wealth solutions that will keep your wealth safe from a declining dollar and from a government that's getting more desperate by the day. The Indians have understood this for thousands of years. Americans are just starting to catch on. When you wear an Owings Metals 24-karat piece of jewelry, you can safely cross borders and take your wealth with you. Best of all, it's insurable, and unlike a lot of Indian jewelry, it's very durable. It can easily be disassembled and sold off in pieces if you need cash. It's surprisingly affordable and definitely should have a place in your wealth diversification strategy. Precious metals are like so many other types of insurance. You only find out how important and essential they are after disaster strikes. Call Owings Metals now at 855-604-6343. 855-604-6343. Don't wait until it's too late. 855-604-6343.
The Financial Survival Network. It's all about what's next.
We are back with John Rubino of dollarcollapse.com. I'm Kerry Lutz. And John, I don't know if you caught this, but they're going to salvage this wreck of a ship that was transporting gold from California to the East Coast, sunk in 1857. They said it was one of the reasons why you had the first modern global financial panic. It sunk, I don't remember where, off the East Coast. And the first guy who was salvaging it, he was a scammer. Now you got the Odyssey salvage operations been contracted to salvage it. And yeah, it's interesting that the global financial panics really go back to 1857, before the Civil War. So we're in another global financial panic. And the only thing that's been keeping the thing from really flying out of control is really keeping the stock markets up. And now, how much longer is that going to go on for? Because if QE is over, which at least by all appearances, it seems to be, the tapering is going on, much to my amazement, but maybe they're doing it another way. So, if the stock markets start going down, John, that's really the end of it, right? There's no way to hold the thing together otherwise, is there?
Well, they've been trying to engineer something called the wealth effect, where they make asset prices go up, use low interest rates and quantitative easing to force the stock market up, keep bond prices up, and make other kinds of hard assets go up in value. And that was supposed to make us feel richer, which would lead us to take nice vacations and eat out in restaurants and buy cars and everything and buy houses, all on borrowed money. Now that's, that sounds crazy when you put it that way, but that is the policy. And it depends on asset prices staying up, because if they start going down, if the stock market has a big correction, say it goes down by 20 or 30% this year, which is a completely normal thing to happen during a bull market, that makes people feel poorer, then they're likely to spend less, and that kicks the economy into reverse. So that's the risk that they're running by trying to elevate asset prices without a correction. And since corrections always inevitably happen, even in bull markets, even assuming you think stocks are going to go up on average for the next 10 years, you're still going to get 2 or 3 30% corrections. But we've made ourselves so vulnerable that a flash crash or 6 months of down stock prices or whatever, the normal kinds of things you get in good times, could turn into bad times in a heartbeat if it spooks the people who are already over leveraged and carry too much debt, and give them a little bit of anxiety, and they're going to start paying off their debt instead of taking on more, and then the system rolls over, and then you get all these leveraged speculating positions out there in the bond market and the derivatives markets and even adjustable rate mortgages and things like that, and you get them blowing up on people. And so the system is so fragile that something like a typical stock market correction could send us into some kind of a 2009 style global financial panic. And that's a terrible thing to have hanging over your head if you're a policymaker or an investor. That's the last thing you want to see is something that starts small and then spins out of control, and that really nobody can stop. And that's the kind of conditions that we've created. We don't know if it'll happen this year or next year or whenever, but something like that is almost guaranteed to happen. And there's a real risk that it ends up being much bigger than the initial perturbation in the markets.
Yeah, isn't that wild that something that starts out as a normal correction, normal market behavior, could all of a sudden just swamp the entire global financial system and turn into this giant cluster, what? Yeah. And just, just go out of control. And
we've created the conditions in which something like that is likely. And so it's just a question of what causes it to happen. What's the catalyst? And it doesn't have to be something very big. It just has to be something big enough to shake one sector's confidence and have that sector become very conservative, start paying off debt, and start seeing asset prices go down. And then that's it. It's game over for the rest of the system. So, Kerry, you mentioned financial crises from the 1800s, and that's a really good point that I think most people don't really get, because everybody seems to think that the Great Depression in the 1930s was the first big financial crisis, and it was due to the excesses of capitalism, and therefore we need a big, powerful government to keep these, keep this inherently unstable system from spinning out of control. But the fact is, there were booms and busts ever since there have been market economies around the world. The U.S. had a depression every 10 or 15 years leading up to the Great Depression, but we don't hear about those other depressions because they were over in a heartbeat. Some sector would get overheated, it would tank, a lot of people would get laid out of work or laid off from work, but then they would find new jobs right away, and the system would go on because the bad debt that caused the crash would be liquidated right away. And people with capital who had, saved their money during the boom would come in and buy up the assets nice and cheaply, and the system would recover and go on as before after one hard year. And the reason the Great Depression is something that we still remember is because that was the era of the central bank in the United States. We'd created the Fed in 1913. And it had helped finance a huge bubble, bigger than anything that had come before. And when that bubble burst, we didn't let the system liquidate. We tried to prop up the zombie banks and builders and everybody, and that prolonged the agony, which is basically what Japan did since the 1990s and what we're doing right now. So we're repeating the mistakes of the Great Depression, and we're probably going to see the same result. We'll see.
Except worse.
Except much worse because the numbers are so much bigger. So it's gonna drag on, and there will be another big financial crisis, and there won't be a fix until we somehow get rid of this debt. Because during the Great Depression, it took like 12 years to work off the debt that had been taken on in the 1920s. And it could have taken 2 years, and we could have gotten it over with. And the same thing now. We could have let the big banks fail, do like Iceland did. Put the bankers in jail for their crimes, let the big banks fail, protect depositors, and just have a hard year and get it over with, and then move on. But we didn't do that, and so now we're paying the price in terms of much higher debt and greater systemic fragility, and an even bigger crisis out there sometime in the not too distant future.
Hey, so you heard that joke, didn't you? Give a man a gun and he can rob a bank, and give a man a bank and he can rob the world, right?
Yeah, and basically we put the bankers in charge in the last 30 years. We created a system in which the government owed too much money and people owed too much money, and the government's one tool to deal with that was to create a lot of new currency, give it to the big banks, who could then use it before its oversupply made it less valuable. So they became the richest, most powerful sector of the system, and they took over the political process. So now you have the bankers in charge, basically. And of course, since their business is debt, the system is getting more and more indebted. It's now government policy to encourage us to take on debts, and which is basically assets of the bank. We now owe the bankers of the world more money than we've ever owed the bankers before. And that's great for the bankers, at least in the short run, because that means they've got all kinds of interest payments coming in. They make bigger year-end bonuses. They get to retire rich and famous and leave the mess for their successors. So we're getting exactly what you would expect by putting the bankers in charge of the global financial system. And therefore in charge of the governments of the world, and therefore in charge of us. So this won't come as a surprise to historians when they sort all this out. And it's only because we don't see it because we're too close to it.
And we're going to talk more about the legacy of the baby boomers when we come back on the Financial Survival Network.
FSN Radio.
Are you worried about protecting your wealth against a dollar collapse? Worried about gold confiscation? Owings Metals provides wearable wealth solutions that will keep your wealth safe from a declining dollar and from a government that's getting more desperate by the day. The Indians have understood this for thousands of years. Americans are just starting to catch on. When you wear an Owings Metals 24-karat piece of jewelry, you can safely cross borders and take your wealth with you. Best of all, it's insurable, and unlike a lot of Indian jewelry, it's very durable. It can easily be disassembled and sold off in pieces if you need cash. It's surprisingly affordable and definitely should have a place in your wealth diversification strategy. Precious metals are like so many other types of insurance. You only find out how important and essential they are after disaster strikes. Call Owings Metals now at 855-604-6343. 855-604-6343. Don't wait until it's too late. 855-604-6343 now.
The Financial Survival Network. It's all about what's next.
And we're back on the Financial Survival Network. I'm Kerry Lutz. We're speaking with John Rubino of dollarcollapse.com. So John, you and I, both baby boomers, at least I am, right in the thick of it, 1957. And we're leaving quite a legacy for our children and their children. And, they're going to look back at our generation, the most selfish, narcissistic, into themselves, self-centered, and just, if you want it, just take out a credit card. If you really want it, take out a home equity loan or refinance. I mean, my parents had a mortgage on their house, and they actually lived to see that mortgage getting paid off and burning the mortgage. How many people in our generation are ever going to live to see the day when their mortgage gets burned, huh?
Yeah. I've written a couple of things about boomers finally getting what they deserve during the financial crisis. And a lot of people wrote in with comments saying, oh, you can't blame the baby boomers. They were fooled, blah, blah, blah. And you know what? We were in charge, Kerry. Our generation has been in charge since the 1990s. So if it's not our fault, whose fault is it? We have basically, like you said, been selfish at every step of the process. From the time that we were protesting against the Vietnam War, not out of any real sense of idealism, but because they were trying to send us off to get killed in the jungle. We didn't want that to happen. And that's one part of our selfishness that I have to say I agree with. But from then on, we became basically these narcissistic people who put their imprint on society at every step. And it's always been via borrowed money. We've always gone for what we wanted and just borrowed whatever it took to get it. And even during our 30s and 40s, when we should have been heavily into saving, because that's when you wake up and think, oh my God, I have to retire in a few years and I don't have any money put away. I'm going to save like crazy. That's how a normal generation progresses through its life cycle. Boomers didn't do that. We kept on borrowing money right up until the time when we turned 60 and 65. We're still buying houses and things out there right now. And so debt during the era of the boomers' ascendancy has increased exponentially in the U.S. and around the world. And you can't blame it on anybody else. It's our fault. We're the ones who pulled out the credit cards and bought all that stuff. We're the ones who voted for people who promised us more free stuff, bought with money that we borrow from our kids and our grandkids. So and it looks like at least the first part of the boomers, the leading edge, are going to get to retire and get full benefits for a while. I think the later boomer retirees are going to see some dramatic cuts one way or the other. Either the actual number of your Social Security payments are going to go down because the government's out of money, or the real value of those checks will go down dramatically as we depreciate the dollar. And so in that sense, it'll be poetic justice, but it's still going to be painful for everybody who's involved in it. And it's going to hurt the boomers who didn't participate in this debt orgy, along with the ones who do or did. And so it's going to be really indiscriminate pain, and it's going to be unavoidable pain for a lot of people because we really haven't, as a generation, saved what we should have saved in order to finance our own retirement. So we're going to be dependent on the government to pay for our health care and give us big Social Security checks every month, and we're going to be dependent on our kids to make up the difference. And unfortunately, our kids, if things go as they're trending now, are going to be taxed to the point to pay for our social programs that they're not going to have anything left over to use to take care of us. So it's going to be a really ugly intergenerational conflict when our kids and our grandkids have to look at us and say, look, I'm sorry, I can't take care of you anymore. And then we go to the government and the government says, well, hey, we're giving you these checks. But of course, the checks aren't worth nearly what you thought they were going to be. So a lot of boomers are going to have retirements that are a lot harder than they expect right now.
And you might all be living under one roof, too.
Yeah. You're going to be changing diapers at the age of 75, a lot of boomers are. So, and again, poetic justice. We should have taken care of this. We had a chance in the 1990s to reform entitlements. We didn't do it. We had a chance in the 2000s to reform the global military empire, to call our soldiers home instead of expanding our reach around the world and now running up a $1 trillion a year military bill. We didn't do that. So we had our chances. And at each step of the process, we made the wrong decision. And, for countries, debt works the same way as it does for individuals and families, which is to say, if you borrow too much, your life sucks. There's nothing mystical, magical. There's no ideology at work here. There's just numbers that don't balance. And we have made, the boomers, we boomers have made the numbers not balance. And so now we and our kids and our grandkids are going to have to pay the price, whatever that price turns out to be, to bring these numbers back into balance. And it might be through currency devaluation. It might be through mass defaults and layoffs of millions and millions of people. And it might be a combination of that. But one way or another, the numbers have to eventually balance, because that's the nature of the financial universe. And so we're going to live through a time in which the numbers are brought back into balance, and it's going to be very painful and chaotic, and there's going to be a lot of blame to go around. There's going to be a lot of finger pointing, and it's just going to be an ugly time compared to the good times when we could borrow as much as we wanted with no adverse consequences in the near term.
Yeah, that self-indulgent, instant gratification lifestyle. Yeah, that's coming to an end. The sooner the better, because it really didn't make anybody any happier, and it was unsustainable. They talk about sustainability. The first key to sustainability is that your balance sheet is sustainable. Forget about sustainability of the Earth's resources. Your financial resources have to be sustainable, right?
Yeah. I have to say that in the short run, it is nice to borrow money.
Yeah.
It's really pleasurable in the moment to be able just to sign your name to a document and then take home some big, huge thing that you have wanted for a long time. I get the immediate gratification thing, but in the long run, it's going to come back to bite us. And the old Keynesian saying that in the long run, we're all dead. Well, yeah, in the long run, we're all dead, but our kids have to live in our long run. And so we put our kids in a situation where they aren't going to get to just sign their names on things and on documents and take home big, cool items anymore. And their money is going to go to support us and to desperately try to raise their kids. It's going to be a very hard life compared to what we lived through.
Very true. And that's why you need to be planning now. Minimalist lifestyle, like Aaron Clarey, Captain Capitalism, says, get real about what's going to happen here, because so many of you still leading this delusional lifestyle that's just not going to go on that much longer. It can't. How many people have really woken up to this fact, John?
Well, a few people have, but it does seem like, based on just the raw numbers out there, consumer debt is starting to go back up again. People are taking out high-cost car loans. We're starting to do subprime lending in housing again, and that's just crazy in this world, and yet it's happening. So, yeah, it looks like a lot of people really don't get what's coming yet. And so if you do get it, you obviously want to live smaller than you have in the past and use the cash that you free up in that way to rebuild your finances. Pay off your debts, tear up your credit cards, live just on what you make minus what you save. And in that way, you protect yourself against the really extreme possibilities that come with all this debt. And at the same time, it's possible, if you have some free cash, some capital, that you can make a lot of money from the transition too, because big changes like this lead to extreme moves in financial markets. And so there's a whole group of people out there that are going to get very rich in the next few years by betting correctly on these big moves in the financial markets. And one probable bet is precious metals. It's probable that if we're going to actively try to depreciate the dollar in order to make our debts less onerous, that hard assets go up in dollar terms, because the dollar is really just the measuring stick for assets that exist in limited quantities out there. So you'll see old forms of money like gold and silver go up. You'll see farmland get a lot more valuable. Certain kinds of rare art, if it's really well chosen, will go up in value. And so to the extent that people shift their finances in the direction of hard assets, they'll probably make money on this transition. So, during the Depression, for instance, there were a whole lot of new millionaires made by people who bet against the stock market and bought really, really high quality bonds, which went up in value during the deflationary part of the Depression. And similar things will happen this time around. So in that sense, this is really an optimistic story. We're talking about how horrible life is going to be for people and all these horrible mistakes that we've made to bring us to this point. But in the process, we've created some extraordinary opportunities. So we should really think of this, at least for ourselves as individual investors as a really optimistic time, Kerry. We have a chance to make a lot of money going forward.
Yeah.
If we time this right, if we make the right decisions. And
I'll tell you one right now. And not to give financial advice, because I always kid people, if you listen to me, you're guaranteed you're going to lose money, at least in the short run. So there's my disclaimer. But look at the ratio of gold to silver right now, 67 to 1. Okay. 67 to 1. It hasn't hit that high since Mickey Fulp and I started doing our monthly precious metals and major market review. 67 to 1 on gold to silver ratio. And just to tell you right now what it is on Cinco de Mayo, I'm looking at Kitco, okay? So gold spiked today and Friday. It's back over $1,300 the ounce. It's $1,311 the ounce. Silver is still stuck in this range, just under $20. It's $19.58 the ounce, okay? So you're looking at 67 times the ratio. When out of the ground, it's like 11 to 1. So, I mean, that is something that's glaring, and it doesn't stay that way for very long. That much is for sure. When it's going to happen, I can't tell you because I'm lousy at this stuff, and I'm the first to admit it. I'm no market timer. But 66.9 is the ratio, meaning it takes 66.9 ounces of silver to equal 1 of gold. And gold is really probably below what its price should be at this particular moment in time. But, you know, you got this deflationary, inflationary argument. Anyway, we got to run, John, but always a pleasure. And we'll be talking to you again next week. So go over to dollarcollapse.com, get the latest in John's thoughts on the economy and the world and everything else. It's where I start my day. And while you're at it, go over to financialsurvivalnetwork.com. Subscribe to the newsletter. Today is my piece on the World Trade Center rebuilding effort. I'll be giving you my thoughts on it. John, we will talk to you again next week. Be well.
Great. Thanks, Kerry.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.